Welcome back to the Quarterly Call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. Today, we're really getting into the weeds on the Federal Open Market Committee meeting from September 17th, 2025.
Yeah, this was a big one.
Definitely. It felt like maybe one of the most critical policy decisions we've seen this year, mainly because the backdrop, the economic situation, it's just so unusual, right? It doesn't fit neatly into any box.
Absolutely. So our goal here is to unpack the sources, figure out why they decided to adjust the policy interest rate this time around.
And crucially, explore that real tension.
Yeah.
The one gripping their dual mandate.
Yeah.
Maximum employment and stable prices. It feels like they're being pulled in two directions.
It truly was a fascinating moment to analyze. The headline news, of course, was the decision to lower the policy interest rate by a quarter percentage point.
Right, setting that new range at 4% to 14%.
Exactly. But what makes this so significant isn't just the cut itself, it's the why, the context. For the first time in quite a while, this action was explicitly taken not because the economy was, clearly falling off a cliff.
No, definitely not that.
But because the balance of risks has fundamentally shifted. That's the key phrase they used, away from just focusing purely on inflation.
That concept, the shifted balance of risks, that's really the core puzzle here, isn't it?
I think so.
Because, look, for the better part of 2 years, policy was restrictive, very deliberately so. They were leaning hard against inflation, even if it meant, potentially slowing down job growth.
That was the trade-off.
So, what specific signs, what data was compelling enough for the committee to, ease up a bit on that anti-inflation stance, even just slightly, especially when inflation is, let's be honest, still elevated?
Well, the shift seems driven by this gradual but, you can't deny it, softening in the labor market.
Okay.
Policy had been restrictive for a clear purpose to cool down what was a red-hot labor market. But as the data started to look weaker, that restrictive policy itself started to become a bigger risk to the employment side of the mandate.
Ah, okay, so the risk profile changed.
Precisely.
Yeah.
The consensus views seem to be that the risks, which were previously tilted very clearly, very heavily toward inflation,
Right.
are now moving closer to being equal. Parity between the inflation goal and the employment goal. So this quarter-point cut, you can see it as an attempt to sort of rebalance those scales.
Acknowledging that the downside risks to jobs are now, real.
Yeah.
Material.
Material, exactly.
So, okay, it's a moderate move, this quarter-point cut.
Mm.
But importantly, they also decided to continue reducing their securities holdings, right? The balance sheet runoff is still happening.
Absolutely. And that continuation of the runoff is, I think, quite telling.
How so?
Well, if the committee were truly terrified of a sharp economic slowdown, or maybe some kind of liquidity crunch hitting the financial system, they would likely have stopped the runoff, halted it. The fact that they're continuing this normalization process, even while cutting rates slightly, signals something.
Okay, what does this signal?
It signals they view the overall financial system as pretty stable. And the economy, it's slowing, but it's not, seizing up completely.
Got it.
They also recognize that the pace of runoff is smaller now. It's less impactful on the big picture, the macro conditions, than it was maybe a year ago. But its persistence, keeping it going, it underscores that this rate cut is kind of surgical. It's targeted, not some systemic flood of easing.
And the chair specifically framed this cut, not as a reaction to a downturn that's already happened, but more as a, quote, risk management move. What did that actually mean in practice, framing it that way?
Yeah, that's a good distinction. It's sort of like the difference between, say, treating an injury you already have versus taking out insurance against something bad that might happen down the road.
Okay. Preemptive.
Exactly. A risk management move is preemptive. It's designed to guard against the possibility of the labor market getting rapidly worse from here.
Trying to avoid that scenario where things deteriorate fast and then they have to panic later.
Right. Avoid having to come in with much larger, maybe more disruptive cuts later on if things really unravel. They see some warning lights flashing, particularly on the job creation front, and they're just easing financial conditions enough to hopefully prevent this current softness from turning into a really deep contraction.
So it's based on forecasting risk, not just reacting to where the unemployment number is today.
That's a perfect way to put it. Forecasting risk versus reacting to the present.
Okay, and that framing, that risk management idea, that probably explains why we didn't see a more aggressive, say, 50 basis point cut.
Precisely.
Because if the main worry was an immediate recession, you might have expected a bigger move.
Exactly. There just wasn't widespread support for a larger cut because despite the softening labor market, the general view seems to be that policy isn't like wildly out of place right now.
It's not seen as drastically too tight.
Right. If you look back at times when the Fed did make those big 50 or 75 basis point cuts, those were usually periods where they felt they were dramatically behind the curve, either way behind on inflation or way behind on heading off a recession.
Okay.
Here, the thinking seems to be that the policy rate has been, mostly appropriate given the circumstances, and this adjustment just nudges it a bit closer to what they might think of as a neutral setting.
Sort of acknowledging the lower growth reality without hitting the accelerator so hard it reignites inflation.
Exactly. You don't want to induce an unnecessary demand surge.
And given the clear differences of opinion within the committee, which we absolutely need to talk about later with the projections, it's really important to stress this isn't the start of some guaranteed series of cuts.
Oh, absolutely. That message came through loud and clear. Policy is emphatically not on some kind of preset course.
Right.
Every single decision from here on out will be made, as they always say, meeting by meeting.
Contingent entirely
On the incoming data, how the economic outlook evolves, and crucially, that balance of risks, how they see it at that specific moment. This meeting felt like it was about shifting the overall bias, maybe tilting the scale slightly, not locking in a specific path downwards.
Okay, so that shift in bias, that tilt, was really forced by this very unusual tension in the dual mandate. Let's dig into that now, starting with the main reason for the cut, the softening labor market.
Right. The employment side really provides the clearest rationale for the adjustment they made.
What did data show specifically?
Well, the unemployment rate, it edged up slightly to 4.3% in August. Now, look, 4.3% is still pretty low by historical standards.
Sure.
But the real concern, the acute worry, lies in the momentum, or rather the lack of momentum in job creation.
Yeah.
Payroll job gains have slowed way down, significantly, averaging just 29,000 per month over the previous 3 months.
Yeah, 29,000 jobs, averaged over 3 months. That is a dramatic slowdown compared to earlier this year or last year.
Huge slowdown.
So just to put that number, 29,000, into perspective for people listening.
Yeah.
For the labor market, just to sort of tread water, just to keep the unemployment rate steady.
Yeah.
How many jobs does the economy need to create each month? This is that break-even rate they talk about.
Yeah, and that's the really critical piece of the analysis here. That break-even rate, the number of jobs needed to absorb new people entering the workforce and keep the unemployment rate flat, that number itself seems to have fallen quite drastically.
Why has it fallen?
Well, officials estimate that due to demographic shifts, particularly a big drop in immigration lately, and also changes in labor force participation.
Okay.
The break-even rate might now be running somewhere between, say, 0 and maybe 50,000 jobs per month. It's a much lower bar than it used to be.
0 to 50,000. That's a huge change from what we used to think.
It is. But even using that significantly lower range, 29,000 jobs a month is barely holding steady. It suggests labor demand has really softened, almost to the point of stagnation relative to how the population is growing.
So it confirms the labor market really isn't tight anymore.
Definitely not tight.
And, whenever the labor market starts to show cracks, the pain isn't usually spread evenly, is it? We're probably already seeing weakness concentrated in certain groups or sectors.
That's exactly what the report detailed. We're seeing those classic sort of leading indicators of distress in certain segments.
Like what?
Growing concern for economically vulnerable groups. For instance, Black unemployment is now noticeably over 7%. Youth unemployment is up. And there are reports that recent college graduates are having a harder time finding those entry-level jobs that match their degrees.
Yeah, I've heard anecdotes about that.
These groups are often the first to feel the effects when overall demand starts to slow down. When you see these margins starting to fray, it suggests the underlying momentum of the whole labor market is pretty weak.
And that significantly increases that downside risk the committee is trying to manage with this rate cut.
Exactly. It makes that risk management approach seem much more necessary.
This brings us to that really unusual labor market dynamic they highlighted. This idea that the low hiring rate is happening alongside a surprisingly low layoff rate. That feels counterintuitive. Usually, slowing means layoffs pick up.
Right. This low hiring environment is the core puzzle. It's strange.
So why is it happening?
Well, companies are just not hiring aggressively. That clearly reflects the slowdown in overall demand. But at the same time, they seem to be holding on to their current staff more tightly than usual.
Hold on, if demand is slowing.
Likely because of how painful and costly it was to rehire after the pandemic. They remember those difficulties.
Okay, scarring from the Great Resignation or whatever we called it.
Could be. So the deep concern now, the risk they're trying to mitigate with this cut is what happens if that low layoff rate stops being a feature? What if it changes?
Right, if companies suddenly do start letting people go.
Exactly. If corporate profits get squeezed further, or maybe efficiency drives lead to big job cuts and that layoff rate suddenly spikes, then the current low hiring rate means those displaced workers would find it incredibly difficult to find new jobs quickly. There just aren't many openings.
Ah, so that's how a soft patch could turn into something much worse, a real hard landing.
That's the fear. That's the potential tipping point the Fed is trying to sort of inoculate the economy against.
Okay, that really clarifies the rationale, the motivation for the cut from the employment side. But now we have to look at the other side of the coin, the part that argues against easing. Price stability. Inflation is still, well, stubbornly high.
Yes, the persistent challenge, that hasn't gone away.
What are the latest numbers there?
Total PCE prices, which is the Fed's preferred measure, they rose 2.7% over the 12 months ending in August.
Okay, 2.7%. Still well above 2%.
Definitely. And core PCE, which strips out food and energy, that was actually higher at 2.9%.
Almost 3% on core.
Yeah.
Yeah.
And crucially, both of those numbers, total and core, are actually a bit higher than they were earlier in the year.
So inflation progress has stalled or even reversed slightly?
It appears so. And they remain, in the Fed's own words, somewhat elevated above that long-run 2% target. So yeah, this confirms the job on the inflation front is absolutely not done. Far from it.
Where is that renewed pressure coming from? If the economy's slowing, you'd think inflation would be cooling more decisively. It feels a bit counterintuitive.
The analysis points pretty clearly to the split between goods and services inflation.
Okay, break that down.
We are seeing continued disinflation prices rising more slowly in the core services sector, and that's the welcome trend. That's what they wanted to see.
Right.
However, inflation for goods has actually picked up quite a bit. Goods inflation registered 1.2% over the last year.
1.2% for goods. Is that unusual?
Very unusual in the modern era. If you look back over, say, the last 2.5 decades, goods prices usually tended to fall slightly year after year. Think globalization, cheaper electronics, efficiency gains.
Right. Deflation in goods was normal.
Exactly. So this positive 1.2% goods inflation rate is highly unusual contextually, and it seems to account for most of the recent upward stickiness we're seeing in the overall core inflation number.
Okay, so if services inflation is easing like they want, but the total core number is stuck near 3%, basically means this surprising rise in goods. Inflation is almost entirely responsible for keeping inflation stubbornly above target right now.
That seems to be the case, yes.
And that rise in goods inflation, I suspect, brings us squarely to the next major underlying driver we need to discuss.
You guessed it.
The impact of tariffs and trade policy.
Exactly. Let's get into those underlying economic drivers now, starting maybe with the constraints on the labor market itself. The chair was quite clear that the slowing labor supply isn't really something the Fed can easily fix with interest rates. It sounds more structural.
Right. Rate cuts boost demand, not supply.
Precisely. The primary drivers of this slowing labor supply are attributed mainly to two big factors: a significant decline in immigration levels and a persistently low labor force participation rate. People just aren't joining or rejoining the workforce at the rates we used to see.
And that's critical because, like you said, monetary policy cutting rates, it influences the demand for labor. It makes companies want to hire more.
Right.
It can't magically create more available workers if they aren't there or aren't looking.
Exactly. If the labor force is structurally constrained by, say, lower immigration, then the maximum level of employment the economy can actually sustain without triggering wage inflation is simply lower than it used to be.
It shrinks the Fed's playing field, in a sense.
It really complicates the whole exercise. It makes that risk management rate cut seem necessary to protect the jobs we do have, but it also limits how effective rate cuts can ultimately be on fixing the underlying supply-side problem.
And on that labor force participation rate, is the thinking that this is just demographics and aging population, or is some of it potentially reversible if conditions improve?
The sources suggest it's probably not just the long-term aging trend, although that's part of it. Some portion of the significant drop in participation we've seen over the past year is likely cyclical or related to maybe other short-term factors. It could potentially reverse if demand became exceptionally strong again, but well, it hasn't yet.
But the decline in immigration seems more concrete, more persistent, maybe.
That appears to be the assessment, yes. And that forces a more structural rethink of that break-even job growth number we talked about earlier.
Got it. Okay, let's pivot to the tariffs. What specific evidence did the committee look at regarding how these are actually impacting prices right now?
Well, analysts have tried to quantify it. Their estimates suggest that the recent tariffs have contributed an observable amount, specifically around zero point 0.3 to zero point 0.4 percentage points, to that 2.9% core PCE inflation rate we mentioned.
So nearly 0.5% of core inflation is directly attributable to tariffs.
That's the estimate. It's a measurable impact from a political policy decision, actively pushing the inflation gauge higher right when the Fed is trying to get it down.
What's the baseline forecast for how this plays out? Do tariffs keep boosting inflation indefinitely?
The base case prediction, or hope perhaps, is that these tariff effects will mostly be a relatively short-lived kind of one-time shift in the level of prices.
Meaning prices jump up once, but the rate of inflation doesn't keep accelerating because of them.
Exactly. Prices reset higher, but then inflation settles back down. However, the risk is still there that these effects could become more persistent.
How could that happen?
If expectations shift, for example. If businesses and consumers start expecting higher inflation because of tariffs, that can become self-fulfilling. Or if the way costs are being absorbed changes.
Okay, so who is bearing those tariff costs right now? Is it hitting consumers directly at the checkout yet? Or are businesses absorbing it first?
This is where the analysis gets really interesting, actually. The observation, based on the data they're seeing, is that the costs of these tariffs are, for the most part, being absorbed by domestic companies.
Domestic companies, you mean the importers, the distributors, the retailers here in the U.S.?
Exactly. Those intermediaries sitting between the foreign exporter and the final American consumer, these firms seem to be taking a significant hit to their profit margins.
They're unable, or maybe just unwilling, to pass the full cost along to us, the consumers, at least for now.
That seems to be the case. The pass-through into actual consumer prices has been, quote, slower and smaller than many economists initially expected.
Okay, but that feels like a potential ticking time bomb for inflation down the road, doesn't it?
It certainly creates a clear future upside risk to inflation that the Fed has to watch like a hawk.
Because if those intermediary companies eventually run out of room to absorb those costs, if their margins get squeezed too much,
Right.
or maybe if they just decide the economic environment allows it, and they do start passing those costs through more fully.
Then we could see a fresh, pretty immediate jump in the inflation data. Yeah.
Yeah.
Even if overall demand isn't surging.
So the Fed's job, then, is to make sure that this unavoidable one-time price level increase caused by tariff policy doesn't sort of seep into the system and become an ongoing, persistent inflation problem.
Exactly. Specifically by preventing it from feeding into things like wage demands or longer-term inflation expectations. That's a key transmission mechanism they need to block.
Okay. Let's pull back a bit and look at the broader economy. Overall economic activity. GDP growth has slowed, you mentioned, but it doesn't sound like a complete disaster yet.
No, not a disaster. GDP grew at about 1.5% in the first half of this year,
Okay.
which is a noticeable drop from the 2.5% pace we saw last year. So a clear moderation.
And what's driving that slowdown?
Primarily, it reflects a moderation in consumer spending. People just aren't spending quite as freely as they were. But the really critical takeaway here is the highly concentrated nature of the growth that we do still have.
Concentrated, meaning it's not broad-based?
Not really, no. And that's where the economy feels profoundly sort of bifurcated, split in two. Well, the current growth seems disproportionately driven by really robust business investment.
Ah, okay. Not consumer spending.
Right.
Yeah.
Particularly investment in equipment and intangibles, think software, R&D, and it seems primarily focused on the big AI build-out that's happening.
The artificial intelligence boom.
Exactly. This surge in AI-related capital spending seems to be an unusually large and very focused source of economic activity right now.
So this mixed, strong business investment, especially in tech, but slowing consumer spending. What does that imply about who is benefiting?
Well, it suggests that the economic benefits might be heavily skewed towards, say, higher income groups, maybe shareholders, and specific technological sectors. It potentially leaves large parts of the traditional consumer economy and maybe lower income households feeling left behind.
Okay, that makes sense. How does that kind of bifurcated growth and the generally higher interest rates we've had translate into the housing sector? That's usually very sensitive to rates.
Yeah, The housing sector remains persistently weak. That's kind of the inevitable result of the cumulative impact of high interest rates over the last couple of years.
No surprise there.
No. However, this policy rate cut, this quarter-point move, it should eventually start to filter through. It might lower borrowing costs a bit for builders, maybe raise demand slightly at the margins.
But probably not a game changer for housing yet.
Likely not a game changer on its own, no. It's generally acknowledged that the housing sector probably needs more substantial, more sustained rate relief to really recover. And that's on top of the deeper, sort of non-cyclical issues like housing shortages that plague many parts of the country. Those aren't fixed by rate cuts alone.
Right. Okay, before we get to the Fed's own projections for the future, there are two other really essential pieces we need to touch on for policymaking. First, the financial health of the average consumer. And second, the quality of the actual economic data the Fed relies on.
Both crucial.
Starting with consumer stress. We keep hearing this narrative that, in aggregate, household balance sheets look okay, lots of savings still. But are there signs of stress building underneath, especially for more vulnerable households?
Oh, definitely. The data really paints that picture of bifurcation again and growing stress at one end.
What are the signals?
We have clear warning signs, particularly at the lower end of the income spectrum. FICO scores, for example, average FICO scores are down by about 2 points across the population.
2 points doesn't sound like much.
Well, officials specifically noted this is the most significant drop they've seen since the Great Financial Crisis back in 2009. And that's happened without us even being in a recession yet.
Wow, okay. That puts it in perspective. What else?
Delinquencies, people falling behind on payments, they're elevated for auto loans, personal loans, and credit card debt. So while it's true that the aggregate household balance sheet might still look okay overall, largely due to gains at the top end, the pressure on lower and middle income households is clearly visible and rising, and that reinforces the need for that policy cut, right, to support the labor market, which is where these individuals primarily find opportunities.
Makes sense. Now let's tackle data reliability. This has been a recurring theme. We've heard concerns about noisy data, conflicting signals, and then there was that preliminary benchmark revision for jobs earlier this year. It showed a truly massive job overcount, didn't it?
Massive is right. The preliminary revision suggested the initial reports had overstated job growth by about 911,000 jobs over the prior period.
911,000, that's enormous. What percentage was that of the originally reported growth?
It was something like 51% of the jobs they initially thought were created. So yeah, a huge revision downward.
How can the committee possibly make informed decisions in real time when the very foundation of their employment data seems so, well, unstable? That's a huge miss.
It's a major, major structural challenge for them right now. No doubt about it. Officials acknowledge the noise. They know the data is messy.
What are the main reasons for the noise?
It seems to stem from two main issues. First, persistently low response rates to the government surveys used to collect the data. Fewer businesses are responding.
Okay.
And second, ongoing difficulties with what's called the birth-death model.
Right, the birth-death model. Can you quickly explain what that is and why it's causing problems now?
Sure. The birth-death model is basically a statistical adjustment. It tries to estimate the net number of jobs created by brand new businesses starting up the births minus the jobs lost from businesses shutting down the deaths.
Why do they need a model for that? Can't they just count them?
Well, it takes time for new companies to actually show up in the official survey sampling frames, so the model tries to forecast this net change from business dynamism in the timeliest way possible.
Okay, and why is that model struggling now?
Because when the economy is undergoing really rapid shifts like the pandemic boom or the sharp slowdown we've seen since the rate of company formation and destruction becomes highly volatile, it swings around a lot.
And the model can't keep up.
The model often struggles to capture those big swings accurately in real time. It tends to lag or smooth things out too much, leading to these large systematic errors like that huge 911,000 job overcount we saw in the preliminary revision.
So relying too heavily on that very first initial data release each month could lead policymakers to fundamentally misread the economy's strength or weakness in real time.
Exactly. That initial print can sometimes be wildly misleading. Now, officials maintain that the data eventually becomes sufficient for policymaking.
Oh.
Because the quality improves quite significantly with the subsequent revisions, usually by the second or third month's release, as more actual survey responses come in and get processed.
So the real issue is timeliness, not ultimate accuracy?
Largely, yes. Timeliness is the big problem. They're essentially forced to make policy decisions based on data that is inherently lagged and known to be volatile in its initial release.
So how do they deal with that uncertainty?
They argue that their risk management approach to policy helps them factor in that data uncertainty. Rather than reacting mechanically to every noisy preliminary number, they try to look at the trends, the broader context, and manage the risks accordingly.
Okay, that makes sense. Let's move to the forward outlook then. The Summary of Economic Projections, the SP. This is where the committee members lay out their forecasts. What is the committee's collective view on the path for interest rates and the economy looking ahead?
Well, the SCP basically confirms the expectation of continued gradual easing from here.
Okay.
The median participant, the middle-of-the-road view, projects the Fed funds rate finishing this year, 2025, at 3.6%.
3.6%. That implies more cuts are coming this year.
It does. Compared to the current 4 to 4.25% range, yes, the median expects more cuts before year-end. And looking further out, the median sees the rate dropping to 3.1% by the end of 2027.
And how does that compare to what they projected back in June?
Notably, this entire projected path for rates is a full quarter percentage point lower than what they projected just 3 months ago in June. So it directly incorporates this recent policy cut and suggests a slightly more dovish path forward overall.
Okay, so they expect to continue easing policy. But if the policy rate is being lowered, when do they actually expect to hit their inflation target? When does inflation get back to 2% in these projections?
Well, here's where that persistent challenge to their credibility really comes into focus. The median projection indicates that total PCE inflation will not return to the 2% target until sometime in 2028.
2028, that's still years away.
It is, and this has become a recurring issue, frankly. If you look back, pretty much since 2015 or so, the CIO has consistently forecast hitting the 2% inflation target about 2 years later than their current forecast horizon allows. They keep pushing it further out.
That feels like a fundamental dilemma, doesn't it?
Yeah.
If the central bank, in its own official forecasts, continually projects failing to achieve its primary price stability goal for years and years into the future, how does it maintain public confidence? That confidence is crucial for monetary policy to even work, right?
It absolutely creates a deep credibility challenge, and it requires a very careful sort of verbal balancing act from the chair.
What's the official line on that? How do they explain it?
The official line is typically that the SEPI isn't strictly a prediction, but rather it represents the policy path that the participants believe is necessary and appropriate to eventually guide the economy back to both of the dual mandate goals, maximum employment and 2% inflation by the end of the forecast period. It's framed more as a statement of intent or commitment.
Okay, less a forecast, more a plan.
Kind of, but the repeated delays inevitably mean the public and markets have to exercise a great deal of patience. And it strongly suggests that some of these underlying factors we've discussed, like the tariffs, the labor supply constraints, are proving much harder or taking much longer to resolve than their economic models initially assumed.
Right. Okay, one other interesting point from the SEP. Despite cutting rates now because of the rising employment risk, the projection for overall economic growth actually ticked up slightly compared to June. How does that work?
Yeah, that paradox is really crucial for understanding the committee's thinking at this particular moment. The median projection for GDP growth was actually revised slightly up to 1.6% for this year and 1.8% for next year.
So they cut rates but became slightly more optimistic on growth.
It seems so, and this really confirms that the rate cut was indeed that defensive risk management maneuver we talked about earlier. It was narrowly focused on the labor market's specific vulnerabilities, especially for those marginal groups feeling the pain. It was not driven by some broad pessimism about the overall aggregate growth path for the economy. That path, perhaps surprisingly, still looks okay to them, likely buoyed by those specific strong pockets, like the AI investment boom we discussed.
Got it. Okay, let's talk about the dispersion of views within those projections now, the famous dot plot, which shows where each individual participant thinks rates should go. It sounds like there was profound disagreement this time.
Oh, the dispersion was unusually wide, yes. And the chair acknowledged this, noting correctly that it's somewhat natural given this highly unusual situation we're in.
Unusual because the two mandates are pulling in opposite directions.
Exactly. When the two mandated goals, employment and inflation, are in such acute tension, every policy decision involves a difficult trade-off. There's really no risk-free path, as the chair put it.
And when there's no easy answer.
Reasonable, well-informed policymakers can look at the same data and reach different conclusions about which the risk to jobs or the risk to inflation is greater at that moment, and therefore what the appropriate policy response should be.
Can we actually quantify that split? How divided were they on the path forward?
Yeah, the dots showed the committee is essentially split right down the middle regarding the next steps.
Really? Evenly split?
Pretty much. 10 participants forecasted needing 2 or more additional rate cuts before the end of this year. So clearly they're prioritizing the rising risk to employment.
Right, that's the dovish camp.
Right. But conversely, 9 participants forecasted needing fewer cuts than that. And within that group, some projected no more cuts at all this year, and a couple even saw rates potentially needing to go slightly higher if inflation proves even stickier than expected.
Wow. So 10 see more cuts, 9 see fewer, or maybe even hikes. That's a massive divergence.
It really illustrates the sheer difficulty of building consensus when the incoming signals are so conflicting. While they managed to unite around this initial quarter-point cut as perhaps a necessary first step in rebalancing risk,
Right.
the path beyond this meeting is clearly deeply contested. It really depends on how each individual member weighs that fundamental employment versus inflation risk going forward.
Okay, shifting gears slightly for our last major section. Institutional integrity and public trust have become really big themes surrounding the Fed recently. There have been questions raised, for instance, regarding the Fed's political independence, particularly concerning a new governor who reportedly maintained some ties to the executive branch. How was that addressed?
Yeah, this is obviously a very sensitive area for the institution. The main defense offered is really rooted in the Fed's long-standing institutional culture and structure.
How so?
The official response emphasizes that the committee's decision-making process itself, which demands that policy choices be based purely on economic data, rigorous analysis, and the goals Congress set in the mandate, serves as the ultimate firewall against undue political influence.
The argument being that the process filters out politics.
Essentially, yes. The idea is that to actually persuade enough colleagues to shift policy within the FOMC, any participant, regardless of their background or who appointed them or any previous affiliations, must make an intellectually sound, data-driven argument. They have to convince 9 or 10 other expert economists. That inherent DNA of data dependency and analytical debate is asserted as the core safeguard for independence.
Okay. Furthermore, the Fed as an institution has faced some external criticism, including apparently from the Treasury Secretary, about maybe getting too large institutional bloat or suffering from mission creep, taking on too many tasks beyond its core duties. How is the institution responding to those kinds of calls for internal reform or better resource management?
They are responding, and with some concrete operational changes, it seems.
Like what?
The committee noted that they are actively implementing a planned 10% reduction in headcount across the entire Federal Reserve System. That includes the Board of Governors in D.C. and all the regional reserve banks.
A 10% cut in staff, that's significant.
It is, and the stated aim is to achieve zero net job growth within the Fed system over a decade. So basically, keeping overall employment levels consistent with where they were more than 10 years ago.
So trying to demonstrate efficiency and focus.
Exactly. It reflects a commitment to continually examining their own operational efficiency and ensuring their resources, their assets, are sized appropriately for their core mission, not ballooning unnecessarily.
We often talk about the dual mandate, maximum employment, and price stability. But historically, the original congressional mandate also included a third element, moderate long-term interest rates. Is that still viewed as a separate third goal that requires independent action?
That's a great question. And the clarification provided was, no, not really. They clarified that they view moderate long-term interest rates not as a separate goal to be targeted independently, but rather as a natural consequence or outcome of successfully achieving the other 2 primary goals.
Okay. So if they get max employment and stable prices right,
then moderate long-term interest rates should follow organically from that stable macroeconomic environment. It's not seen as an independent lever they need to pull or a third mandate requiring separate policy tools or trade-offs. It basically simplifies their focus back to the core dual mandate.
Got it. Okay, finally, on the public trust aspect, there was a recent Gallup poll mentioned, suggesting that Americans currently have more confidence in the president than in the Federal Reserve when it comes to handling the economy. That must be, well, sobering feedback for an institution like the Fed that relies on public credibility.
I imagine it certainly is sobering, yes. But the official response was quite pragmatic and really focused on institutional resilience.
How so?
Their stated commitment remains singular. Just focus on achieving the mandated goals, maximum employment and price stability, without getting distracted by politics or polls.
Keep your head down and do the job.
Essentially, they'll continue to rely on the data, focus intensely on the mandates given to them by Congress, and believe that, ultimately, letting the economic results speak for themselves is the best way to rebuild and maintain public trust over the long term, irrespective of short-term fluctuations in political sentiment or opinion polls.
Okay, let's try to pull all these complex threads together then.
Yeah.
What's the main takeaway from this September meeting?
Well, I think it boils down to this. The committee made a preemptive risk management style rate cut. Why? Because the labor market, while not collapsing, is clearly showing concerning weakness at the margins. Job creation is barely keeping pace, confirming a real downside risk to the employment mandate.
And they did this even though inflation remains stubbornly above their target.
Exactly, even though inflation is still too high, and, maybe paradoxically, even as their own projections for overall economic growth actually ticked up slightly.
Driven by that concentrated investment in things like AI.
Right, so it's the ultimate monetary policy tightrope walk, isn't it?
It really feels like it.
They're prioritizing the employment goal right now, leaning against the risk of a sharp downturn there because that risk seems to have escalated. But they're doing it while knowing that these other factors, like tariffs, maybe labor supply issues, are keeping inflation stickier than they'd like.
So they're balancing the immediate visible pain potentially felt by vulnerable workers if the job market weakens further against the future, less certain risk of inflation staying too high for too long.
Precisely. And all in an environment where some of their key policy levers feel constrained by these big non-monetary factors happening outside their direct control.
Okay, and that leads perfectly into a final, maybe provocative thought for you, our listeners, to consider.
Right.
Since two of the most significant factors shaping the current economy seem to be largely outside the Fed's control, namely the slowdown in labor supply, driven partly by immigration policy, and the stickiness of goods inflation, driven significantly by tariff policy, both stemming from political or geopolitical decisions. How much control does monetary policy truly retain over this unique economic situation right now? Or is the Fed increasingly finding itself in a position of simply trying to compensate for or react to policy levers being pulled elsewhere in Washington or globally?
Ooh, that is a depth question. And one that will likely, I suspect, define the major policy debates for years to come. How much can the Fed really do on its own in this landscape?
Something to definitely keep thinking about. Thank you so much for tuning in to the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.